If you're buying a house in Canada in 2026, there are five massive mistakes that could cost you tens of thousands of dollars. And most people are making at least three of them right now. In the next 10 minutes, I'm going to walk you through exactly what these mistakes are and how to avoid them so you don't end up overpaying or losing your dream home. Before we dive in, I'm Dion Williams from Williams Mortgage. I work with Canadians all across the country helping homeowners get mortgage free faster. If you want to chat, click the link below and book straight into my calendar. And while you're at it, hit that subscribe button so you don't miss any updates. Now, the Canadian housing market in 2026 looks completely different than it did even 2 years ago. Interest rates have stabilized, but they're still significantly higher than the pandemic era. We're seeing pockets of opportunities across the country, but we're also seeing buyers make that same critical mistake over and over and over again. And here's the thing, these mistakes aren't just costing people money, they're costing them their financial security for the next 5, 10, or even 25 years. But here's what most people don't realize, the biggest mistake isn't what you think it is. It's not about not timing the market or finding the perfect interest rate. The biggest mistake is actually making decisions based on what worked in 2020 or 2021 when the market was completely different. What worked then will absolutely destroy your finances now. So let's break down these five mistakes so you can avoid them. Mistake number one, not getting fully pre approved. The mistake, and this is the mistake I see the most often, not getting a complete pre approval before you start house hunting. Now, I know what you're thinking. Dion, I've already got a pre approval online. I filled out the forms, I got my number. But here's the problem, that's not a real pre approval. That's what we call a pre qualification. And there's a massive difference. A pre qualification is when you fill out an online calculator or application and the lender gives you an estimate based on what you told them. They haven't verified anything, they haven't seen your pay stubs or your tax returns, your employment letter, or your down payment proof. A full pre approval means you've submitted all your documents. Your income's been verified, your down payment has been confirmed, your credit's been pulled and reviewed, and the lender has given you a written commitment that says, yes, we will lend you this amount for this type of property. And in 2026, this matters more than ever because lenders are being way more strict than they were even a few years ago. They're scrutinizing everything, your debt ratios, your employment stability, the property type, the location. And here's what happens when you don't get fully pre approved. You find a house you love, you write an offer with a 5-day condition because that's what your realtor says you need to do to be competitive. And then you scramble to get all your documents together, only to find out you don't actually qualify for the amount you thought you did. Or worse, the property doesn't qualify because it's a condo with rental restrictions, or it's in a rural area that a lender won't touch. I've seen this happen dozens of times in the last year alone. People lose their deposits, they lose their house, and they're devastated. So here's what you do. Before you even start looking at houses, get fully pre-approved. Send all your documents to your mortgage broker or lender. Get everything verified. Know exactly what you qualify for and what types of properties will work. This isn't just about knowing your number. It's about knowing you're actually going to get approved when you write that offer. Mistake number two is writing condition-free offers without talking to your mortgage broker first. Now I get it. Your realtor might tell you, hey, this is a hot property. If you want to win this, you need to go in with no conditions. And in some markets, that might be the only way to compete. But the reality is writing a condition-free offer means you are 100% committed to buying that property, whether you can get financing or not. If something goes wrong, if the lender doesn't approve the property, if your income doesn't verify, if the appraisal comes in low, you're on the hook. You could lose your deposit, which in 2026 is often $20,000, $50,000, or even $100,000, depending on the property. And here's what most people don't know. Even in competitive markets, we're seeing offers with financing conditions get accepted all the time. Just last month, here in Ottawa, I had a client who was told by a realtor they needed to go in condition free. We pushed back and said, let's try a 5-day financing condition and see what happens. Guess what? Their offer was accepted. Why? Because the other buyers were nervous about going in condition free. So it came down to price, not conditions. Now, if you're going to write a condition free offer, you absolutely need to talk to your mortgage broker first. I mean, show them the property, the address, the listing, the condo docs, if it's a condo, because your broker needs to confirm two things. Number one, that you qualify 100% for the mortgage amount. And number two, that the property itself will be approved by the lender or the insurer. Because here's the thing, you might be the perfect borrower if that property has issues like a leasehold, or it's a condo with too many rentals, or it's in a flood zone. The lender might say no. And if you've already waived conditions, you're stuck. So the rule is simple. Never ever write a condition-free offer without explicit approval from your mortgage broker. And if the realtor's pressuring you to do it, honestly, that's a red flag. The right property will come along where you can protect yourself with conditions. Now, before we get into mistake number 3, if you're finding this helpful, do me a favor, hit that subscribe button. I post videos like this every week to help Canadians navigate mortgages and home ownership, and you don't want to miss them. It takes 2 seconds. All right, let's keep going. Mistake number 3, getting caught up in bidding wars and making emotional decisions. Now, in 2026, we're not seeing the same level of intensity or insanity we saw in 2021 and 2022. But in certain markets, especially in Ontario, parts of BC, and some urban centers, bidding wars are still happening. And when they do, people lose their minds. Here's what happens. You find a house, you like it, it's listed at 800,000. You think, okay, I'll offer 850. But then you find out 10 other offers are in play. So you panic and go to 900,000 and then to 920,000. And before you know it, you're at 950,000 for a house that was listed at 800,000. And you've waived your conditions because your realtor said that's the only way to win. And here's the problem. You didn't buy the right house. You won a competition. And winning a bidding war is not the same as making a smart financial decision. Because what tends to happen in markets with bidding wars is this. Prices spike, everyone panics, and overpays. And then, in 3 to 6 months later, the market cools down and you realize you could have bought a similar house for $100,000 less if you had just waited. Now, I'm not saying don't go buy a house. I'm saying don't let fear of missing out drive your decision. If you're in a market where you have to get into a crazy bidding war to buy a house, just wait. Rent for 6 months. Let the market settle. And then buy when you can do it on your terms with financing condition and a reasonable price. Because here's the truth. The right house will come along. And when it does, you'll be able to buy it without overpaying and without protecting or putting your financial security at risk. Mistake number 4 is focusing on only interest rates and ignoring the overall cost of the mortgage. I've had conversations with clients just like last week. We were comparing 2 mortgage options. Option 1 was a discount mortgage at 3.85%. Option 2 was a full featured mortgage at 3.99%. Now, most people would look and say, obviously, I want the 3.85% rate. That's cheaper. But here's what that 0.15% difference actually costs. On a $500,000 mortgage, it's about $25 a month. That's $5 a week, less than a coffee at Starbucks. But here's what you get with a full featured mortgage. You get the ability to break your mortgage within a 3-month interest penalty instead of an IRD penalty. which could save you $10,000 to $20,000 if you need to sell or refinance. You get the ability to switch lenders at renewal without penalty, which gives you way more negotiating power. And you get prepayment options that lets you pay down your mortgage faster. So yes, the discount mortgage rate has a lower rate, but the full features gives you the flexibility. The flexibility is worth way more than 0.15%. Here's the big picture. The clients who chase the lowest rate often end up paying the most over the life of the mortgage. Why? Because they get locked into a mortgage with terrible terms. And when they need to make a change, like selling the house or refinancing to consolidate debt, they get hit with a massive penalty. So when you're comparing mortgages, don't look just at the rate. Look at the penalty structure, look at the prepayment options, look at whether you can switch lenders at renewal. Because the goal isn't to get you the lowest interest rate. The goal is to get the lowest total cost over your life of the mortgage. And those two are very different. And that brings us to mistake number 5, making purchase decisions with short-term thinking instead of long-term planning. This is a mistake that costs people the most money over time. And it's one I see constantly. Here's what I mean. People are buying houses based on what's happening now. They're buying in the suburbs because everyone else is buying in the suburbs. They're buying condos because they're cheap and they think they can flip them in 2 years. They're buying a house that's too small because they're afraid prices are going to go up. But here's the problem. You should be buying based on where you want to be in 10 to 15 to 25 years, not where you want to be in 6 months. Because if you buy the wrong house, you're going to end up selling it in 3 years. And when you sell, you're going to pay realtor commissions, legal fees, and land transfer tax on your next purchase. You could easily lose $50,000 to $100,000 just in transaction costs. So when you're buying a house, ask yourself these questions. Do I actually want to live here for the next 10 years? Does this house fit my long-term lifestyle? Am I buying this because it's the right house, or am I buying because I'm afraid of missing out? And if the answer is that you're buying out of fear or panic, stop, wait, and find the right house. Because the right house is the one you're going to stay in for a long time. And staying in your house for a long time is how you build wealth through real estate. All right, let's recap. If you're buying a house in 2026 in Canada, avoid these 5 mistakes. 1, get fully pre-approved with all your documents verified before you start house hunting. 2, never write a condition-free offer without talking to your mortgage broker first. 3, don't get caught up in bidding wars. Wait for the right house at the right price. 4, don't focus on only interest rate. Look at the total cost and the flexibility of the mortgage. And 5, make the decision with long-term thinking. Buy the house you want to live in for the next 10 to 25 years, not the house that's convenient right now. If you do these 5 things, you're going to save yourself tens of thousands of dollars and a ton of stress. So if this has helped you or you found this valuable, please hit that like button and the subscribe button. And while you're at it, hit that little bell. And if you do want to book a call with me to see how we can restructure your payments and see if we can maybe pay off some debt or just look at your scenario in general, click the link below in the description and you can book an appointment with me directly in my calendar and we'll meet on Google Meets. Thank you so much for watching.